Welcome, fellow investors. Today we have an intriguing topic that will likely reshape your investment strategies in 2023. So grab your favorite beverage, sit back, and get ready to learn about a powerful quantitative trade that's capturing the attention of Wall Street. 2022 is a rough year for the investors around the world. Both the equities and bond markets are down for the year due to the rising interest rates and sticky high inflation. It was a challenging time, but amidst the chaos, there's also a glimmer of hope. AQR Capital Management, a Connecticut-based hedge fund with over $140 billion under management, believes that risk parity investing is ready to make a comeback in 2023. So let's explore why this strategy is capturing the attention of investors and how it can potentially bring profits while minimizing downside risk. But before we plunge into the depths of risk parity, I have a small favor to ask. If you're enjoying this content and want to stay updated with future investment ideas and strategies, don't forget to smash that like button and hit the subscribe button below. By doing so, you'll be part of our community, always at the forefront of the latest investment trends. AQR Capital Management utilizes a research-based and consistent approach to constructing portfolios. Their disciplined method focuses on identifying reliable sources of long-term returns, emphasizing conviction in the process rather than specific stocks. The firm strongly advocates for diversification within portfolios and believes in incorporating strategies with low correlation to traditional asset classes to enhance existing portfolios. AQR has gained recognition for its alternative investment strategies that provide a low correlation to equity-dominated portfolios. They were pioneers in offering risk parity strategies, which prioritize balancing allocations based on underlying risk rather than relying solely on asset classes. So what is risk parity trade? Risk parity trade is a methodology to allocate capital across multiple asset classes. It allocates the portfolio by equalizing the risk contributions of each asset class without considering their expected returns. It then uses leverage to scale the resultant allocation to the desired volatility or risk. Recent research has found that this approach can lead to a superior return for the same level of portfolio volatility. Two key ingredients are necessary for risk parity to deliver superior returns for a particular level of risk. First, the risk-adjusted return, what's also known as the Sharpe ratio, of low-risk assets such as bonds must exceed the Sharpe ratio on high-risk assets such as stocks, such that leveraging a portfolio with a higher allocation to low-risk assets delivers a higher expected return than a direct investment in high-risk assets with the same level of risk. Second, the cost of leverage or borrowing needs to be sufficiently low such that the expected return of the leveraged allocation net of the financing costs exceeds the return of the traditional allocation. For investors who could access leverage efficiently, risk parity historically has been a compelling strategy because bonds have exhibited better risk-adjusted returns than stocks for decades. Okay, before we move on, let's take some time to clarify some of the technical terms. The Sharpe ratio is a measure used to assess the risk-adjusted returns of an investment. It compares the excess return generated by an investment over the risk-free rate to the volatility of those returns. The formula for calculating the Sharpe ratio is as follows. Sharpe ratio equals the return of investment minus the risk-free return divided by the standard deviation of investment. For example, let's compare two investments. Stock A has an average return of 10% and a standard deviation of 15%, while Stock B has an average return of 8% and a standard deviation of 10%. Assuming the risk-free rate is 2%, we can calculate for Stock A, Sharpe ratio equals 10% minus 2% divided by 15%, which is 0.53. For Stock B, Sharpe ratio equals 8% minus 2% divided by 10%, which is 0.60. In this case, investment B has a higher Sharpe ratio, indicating a better risk-adjusted return. A higher Sharpe ratio suggests that an investment provides higher returns per unit of risk taken. Now we understand what Sharpe ratio is, let's move on to see how it plays a role in risk parity. Suppose you have access to two asset classes, stocks and bonds. Let's assume stocks have expected return of 6.25% and volatility of 17.5%. The bonds have expected return of 4% and volatility of 4.5%. Let's also assume that the interest rate, the risk-free rate, is 1.75%. Based on these numbers, we can calculate the Sharpe ratios of stocks and bonds. If you follow the 60-40 method to put 60% of your money in stocks and 40% of the money in bonds, we can calculate the expected return and volatility of this 60-40 portfolio. Here we assume that the correlation between stocks and bonds is 0.2. So your majority as a whole has a standard deviation of 11%, but notice that the majority of the risk, as much as 94% of the risk, comes from investing in the stocks. If the portfolio carries almost the same risk as owning the stocks alone, it kind of defeats the purpose of diversifying your portfolio, isn't it? We're not not saying the 60-40 portfolio is a bad design. In fact, research has shown that over time, a 60-40 portfolio would deliver very good returns. But the main drawback of this composition is that because the portfolio is tilted towards stocks, and stocks are much riskier than bonds, the majority of this diversified portfolio's risk can be attributed to the stock allocation, and that's exactly what risk parity will try to solve. Now let's consider a risk parity portfolio constructed to have the same volatility as the 60-40 stock bond portfolio. This can be done by first put equal risk contributions of the two asset classes and then apply leverage to achieve a target volatility of 11%. This means half of the risk, or 5.5%, comes from stocks and the other half comes from the bond. It turns out that to equalize the risk contributions, the portfolio would need to be allocated 20.5% to stocks and 79.5% to bonds. Now take a look at the overall portfolio risk. With risk parity, a total risk of the portfolio is only 5.5%, or half the 11% targeted volatility. This is because risk parity overweighs bonds, which has lower volatility. So risk parity can produce a portfolio that's lower in risk, but what about the return? Does it deliver superior return compared to a portfolio that has 60-40 split? To find out, let's do some simple math again. For the 60-40 portfolio, we can calculate the return to be 0.6 times 6.25% plus 0.4 times 4% equals 5.35%. For the risk parity portfolio, the return is 0.205 times 6.25% plus 0.795 times 4% equals 4.46%. At first, the risk parity portfolio appears to deliver a lower return than the 60-40 portfolio. But remember, risk parity portfolio's risk at 5.5% is only half of the 60-40 portfolio at 11%. This means an investor can apply 2 times leverage on the risk parity portfolio for the same risk. After leverage, the risk parity portfolio's return rises to 2 times 4.46%, coming out to 8.92%. But at the same time, the investor needs to pay for financing the leverage. Since the risk-free interest rate is 1.75%, we will use 3% for the financing cost. Net financing cost, the return on the risk parity portfolio, becomes 8.92% minus 3%, coming out to 5.92%, still higher than the 5.35% return achieved by a 60-40 portfolio. The ability to achieve a superior return for the same amount of risk is the reason why risk parity strategy became so popular among investors, especially institutional investors who can cheaply borrow money to invest. But in 2022, both bond and equities prices declined due to rapid cases in interest rates. This put risk parity in an awkward position because for this strategy to work best, bond price and equity price should be negatively correlated, meaning when the equity price drops, the bond price would rise. Since both bond price and equity price were falling at the same time, the bond portion of the portfolio did not provide the hedge it's supposed to. As a result, 2022 was a bad year for risk parity. However, as we move into 2023, the traditionally negative link between stock and bond prices has been returning as inflation eases, meaning the treasury market has been rallying when the equities are falling. This is a good sign that risk parity will once again become a profitable strategy. And there you have it, a captivating glimpse into risk parity trade. It's an investment strategy that's primed for success in 2023, offering the potential for superior returns while mitigating downside risk. Remember, knowledge is power, and in the ever-evolving world of finance, staying informed is crucial. If you find this video helpful, don't forget to smash that like button and hit subscribe to stay updated with more exciting investment ideas. Until next time, happy investing!